You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, everybody. Welcome back to the podcast. Today, I thought I would talk about how do you determine your premium? Some people call in or reach out and we're talking together and they already know what premium they want to start with. They already have an idea of what's affordable to them, what fits in their budget. And sometimes they don't. Sometimes they're not sure where they're going to get the funds from to begin a whole life policy because they want to become their own banker and they want to use a whole life policy for that purpose. And so I thought I would go over how to determine your premium. And also I thought I would cover payment modes and what that means and what you're able to do and how you're able to change around your payment mode. You don't have to stick with one. So what are payment modes or premium modes? That just means, when are you paying your premium? Are you paying it monthly, semi-annually, or quarterly, or annually? You can choose one of these different payment modes, and you also can change your payment mode throughout the year. For example, if you're 1 month in and you decide, I want to switch to quarterly, well, then you can pay up the remaining 2 months, and now you'll be billed for every 3 months. Or maybe you're on annual mode and the year comes, your anniversary comes, and your annual invoice gets mailed to you, or you're made aware that you owe for the year. And you decide, I think I want to switch to monthly. I don't have that full lump sum payment. So then you can switch to monthly. You can switch back and forth pretty much whenever you want. They prefer it to be on an anniversary date, but it is possible basically any time. But the other thing you can do is you can pay the base premium on a certain payment mode and also the paid up additions premium on its certain premium mode. They can be on different premium modes. So I have this conversation a lot with people, and I thought this would be helpful to some of you because I know when I'm talking about it, it can be confusing. Hopefully I can explain it well in this podcast. But you could start off on, say, a base monthly premium. Maybe you want to pay the base premium just every single month, but you have already money sitting in a savings account, or maybe you have a CD that's up and you want to move that money into your policy and you want to move it in as a lump sum because it's fully ready to go. And you like the idea of having that money available to you, just like it currently is in your savings account. So if you move it from your savings account to your paid up additions premium on your whole life policy, it will basically all be available to you. So it's like moving it from one pocket to the other. So you would be able to start up the base premium mode on a monthly basis, if that's comfortable for you, and then have your paid up additions premium mode on an annual basis. So then you just can send that money in and you have your monthly base premium happening. Remember, in the first year, you do not have access to that base premium to borrow against it. So you would have access to borrow against the paid up additions, but not the base. And if you select an annual paid up additions premium mode, that doesn't mean you even have to pay it every year on your anniversary date. If you have a $20,000 paid up additions premium, you could send it in all at once. You could send it in $5,000 this month and $10,000 the next month, and then wait 8 more months and send in the difference. Or you could even wait the full year until a few days before your anniversary and choose to pay up the whole paid up additions then. You just want to get it paid before the next anniversary so it counts for that year. Otherwise, likely they'll credit it to the next year. And you'll want to double check on that anyway, because sometimes that can happen, so that it would credit the year that you are in, or the year that you want to pay it, and just make sure that that's happening correctly. But you have that choice and you have a lot of wiggle room. And again, I can't say this is the way it is for every single company. This is the way it is for the companies that I'm aware of and the ones I work with. So I can't say across the board that they all allow the same flexibility, but I do know of a handful of companies that do. And they also might have different rules for that. For example, my primary company, they don't care. You can skip the year altogether of paying your paid up additions and then be able to pay it the following year. You're allowed to skip 4 out of every 5 years without losing the opportunity to fund your paid up additions rider. Of course, That doesn't necessarily mean indefinitely you can fund every few years or skip for every 5 years for the rest of your life. You would still have to watch for putting too much money in and causing the contract to become a mech. So it's best if you can fund that paid up additions as many years in a row that you can from the start. That's really going to fuel the growth of your contract. It's really going to be the best way to fund your contract rather than skip a bunch of years and then pay it again. But you do have the ability. You can skip the year altogether, or if you have, say, a $10,000 paid up additions, you can fund anywhere from $0 to 10,000 in any year. And so there's some more detail to that, but that's the basic high level of it. But some companies, they want you to pay a minimum towards your paid up additions every single month, or some want you to pay at least a minimum for the year, say $100 or $120. So there's differences with different companies, but for the most part, at least for the ones that I work with, you do have much flexibility with that. So remember that when we are building these whole life policies for the purposes of being your own banker, the infinite banking concept, we are building them for efficient cash growth. So that's our target. That's our goal rather than solving for death benefit. So we're not solving for death benefit like is normal as what would normally happen if you're seeing an agent and you just say, I want $1 million of life insurance. Now they're giving you the price of $1 million of life insurance. When it's for the purpose of infinite banking, we are shrinking down that death benefit. We are solving for cash, not death benefit. So we're not starting with the death benefit and then going from there or building from there. We are choosing premium first and then building the policy backwards. So rather than you trying to figure out how much whole life death benefit you want to get started with, you would tell me, or we would determine together, what premium would be fitting for you and fitting for your budget. From there, the architecture will be built upon your personal situation. Do you have a lump sum of savings somewhere that you would want to move into the policy? And if so, do you have a pressing need? And so we'd have to determine over what period of time would we be moving this money in? Do you have a specific need? Do you have a specific thing you're trying to finance or real estate or something where you need a certain amount by a certain time? And then that helps us to kind of figure out the best way to move that cash in. If it's possible, what you want to do is possible. Also, what's affordable to you on an ongoing basis. We'll want to know that so we know what kind of premium you're going to be able to continue once you're through maybe some sort of savings amount that you have, or maybe you had a windfall of some sort. And once we're through those funds, we need to know what are you able to continue with. Do you want room in your policy to add more funds in or later on in the year? Because, like I said, since you are not required to fund your paid up additions right up front or when you start the policy, you have the whole year to do it. Do you foresee a bonus coming, or maybe a tax return, or somebody owes you some money and they're going to pay you back? Do you foresee funds coming later on in the year that we can account for and build into your policy from day one? Because we're going to want to account for that in the beginning, because whatever we start with in premium is basically your ceiling. We are building you right up snug next to the mech line. And so we don't want to be adding more funds than we designed into your contract. Do you see your income growing over time due to promotions or moving up the corporate ladder? We can plan for that. We can plan for building your banking system. Do you plan to begin your own business? If so, when? How much will it cost you to get started? And do you have those funds already saved or plan to acquire the money that you'll need for that? So, all this can be taken into account when you begin so that we can allow for growth of your banking system and plan for that growth. Now, if you see in your future that you're going to want to fund at a higher level, but you're not sure you'll be able to do so or do that in the first year, that might look like a second whole life policy. That might look like acquiring some term so that you can convert that into a second whole life policy in the future if you want to. Or else you're just going through underwriting again and hoping that your rating is the same or better, certainly not worse or not a decline. Again, that's why I like that term insurance that you can convert, because then you get to keep whatever health rating you have when you underwrite, And you can always re-underwrite and try to get a better health rating, but at least you know that you can grow your system without having to go through underwriting again. If you want to grow it later, if you can see funds coming into your future, maybe an inheritance, and you think, I'm going to want to grow my system, it's good to have that term you can convert. And I'm always asked things like, can I add more money to this later? What if I want to double the amount I'm funding into my policy? Or what if I want to add more this year or next year? And so that's why you want to plan for that in advance, what you think is going to happen, and plan a way to grow that system when you're ready. Because if you want to add funds, you very likely are not going to be able to add it into your existing policy without causing a mech. It might be something totally allowable by the company. They may say, sure, go ahead, put twice as much paid up additions as you put in last year. They don't have a problem with it, but that doesn't mean it won't cause a mech to your contract. So you always want to be thinking about that. So acquiring a second policy, it could be on you, it could be on your spouse, it could be on your children. If you end up not having a convertible term, or even if you do and you want to open another policy, a third or a fourth, you can write it on any of those people or possibly another family member if you have an insurable interest in that person and it makes sense. Business partners can also be insured. Another thing that I think is important for you to know is that if you don't get the health rating you expected, or if it's much lower than you expected, that doesn't mean you should scrap a policy on yourself altogether. One great thing about the way we as practitioners are structuring your whole life policy is that it minimizes the portion of the death benefit that is affected by the health rating. The paid up additions are not affected. So if you get a much worse rating than you expect for yourself, that doesn't mean you should reject the offer. On the contrary, the insurance company then feels your life expectancy may be shortened because of your health conditions, and so even more reason to lock in the policy, in my perspective, especially if you have people that are counting on your income. A lot of people are so focused on the cash value that they feel if they can't operate it at its optimum level, then they might as well decline the policy. But to me, again, especially if you have family or someone dependent on your income, that means you should definitely accept the policy if that rating is lower because the company thinks you have a shorter life expectancy. We will minimize the part of the premium that's affected by your health rating as much as we can and get you protected and started with building whole life policy cash values. The good news is that after 1 year, you are able to redo the medical portion of the application in order to try for a better health rating. I know I've mentioned this a few times. If you make some changes in your health, your diet, you start working out, and you feel your rating would be better, you can try for a better rating anytime. Anytime after 1 year, that is. You have to wait at least 1 year before you can try to get an improved health rating. And if it doesn't come back improved, don't worry, they're not going to take away the rating you already have. You'll be able to retain the rating you already have. But if you feel like you're in great health or you've done some health changes and you want to retry for it because your rating wasn't very good the first time, I think it's a good idea. And if you qualify for a better health rating at that future time, then the price of your contracts will be adjusted accordingly. And for the whole life, the cash value would just perform better. So there's really no risk in trying for a better health rating. If you get something that's below standard or something and you're resistant to getting the policy, I say lock it in and try it for a better rating later on when you've made some health improvements. Well, I hope you enjoyed this episode and got something out of today's podcast. As always, if you feel you would like my help as your advisor and would like to connect, feel free to reach out to me at valerie@alphaomegawealth.com. You can also follow me at Valerie LaRoque, Infinite Banking Mastery on Instagram and Facebook, or check out my website, infinitebankingnorthwest.com. Thank you so much for listening and sharing my podcast. I hope you have a great week. Take care.